Given the current tensions in the Middle East, many people are starting to ask practical questions about what would happen to their bank accounts if the situation escalates even further. Now, in normal times, banking system may feel very stable. Your salaries arrive at time, transfers work instantly, and international payments move without difficulty. Because of this reliability, most people keep the majority of their money inside one banking system. The problem is that during the geopolitical conflict, the banking system is often one of the first places where restrictions begin to appear. Transfers can become slower, compliance checks can become more strict, and in some cases, governments introduce temporary limits on capital movement and foreign currency transfers. These measures are usually designed to stabilize the financial system, but they can affect how easily people can move their money. For families with meaningful wealth, an important question appears. That is, if all your liquidity sits inside one country, what would happen if that banking system becomes restricted for a certain period of time? Now, before we go into the answers, my name is Shiraz Wahid and I'm the co-founder at Libertas Wealth, where we help high net worth families and entrepreneurs with asset protection and legacy planning. So if you would like our help with the same, you can request a personalized asset protection plan by clicking the link in description below or reach out to me directly through WhatsApp. I would also request you to subscribe to our channel to benefit from our weekly videos as well as help us grow. Now, during geopolitical conflicts, governments sometimes introduce financial controls to protect domestic banking system. For example, international transfers may face additional checks, large transfers may take longer to process, and banks may ask more questions about cross-border transactions. In more serious situations, bank may slow down large transfers or temporarily pause certain international transactions while the regulators stabilize the system. None of this necessarily means that the banking system has failed, but it can affect how quickly your money can move. For individuals and families where wealth is concentrated in one single country, this creates dependency on one financial system. When families build significant wealth, liquidity becomes very important. Liquidity simply means how easily you can access your money when you need it. If all your money sits in one bank in one country, your access to liquidity depends entirely on that system continuing to operate normally. During geopolitical tension, even small restrictions can make it harder to move funds quickly. Transfers may take longer, banks may ask for more documentation, currency transfers may require additional approvals. This is why many international families plan their liquidity well before any crisis. One common solution is simply maintaining banking relations in more than one jurisdiction. This does not mean closing your local bank accounts. Most families still keep operational banking in the country where they live or their business runs from, but they also open additional banking relationships in other financial centers. If one system becomes temporarily restricted, they still have access to liquidity elsewhere. For example, a family living in the Gulf region may keep their operational accounts locally while also maintaining accounts in other international financial centers. Your ability to access liquidity should not depend entirely on one banking system. As the wealth grows, many families also begin to separate their daily banking from their investment custody. Daily banking may remain with a local bank where the family lives or operates their business. Investment portfolios, however, may be held with international custodians or private banks. This allows the investment portfolio to remain connected to global financial markets even if local banking system face temporary disruption. Many international private banks offer global custody service. These banks hold investment portfolios, securities, and other financial assets under the highly regulated custody framework. This creates another layer of diversification in how the wealth is stored. Now, one jurisdiction that often appears in international wealth planning is Switzerland. Swiss banks have a long history of international private banking and asset custody. Many of our clients use Swiss banks to hold investment portfolios as part of their long-term liquidity. Switzerland is known for a stable legal system, strong financial regulations, and a well-developed private banking industry. And because of this, some families choose to keep part of their wealth there. Now, it is important to understand that Switzerland is usually not the only banking location. It simply becomes one additional jurisdiction within a broader diversification strategy. The idea is not to move all your wealth in one new country. The idea is to spread banking relationships across multiple stable financial systems. Now, due to increased requests from my clients, I will be in Switzerland this month and part of the next months to help my clients set up Swiss banking and diversify their wealth. So if you are someone who can place at least $1 million with a Swiss bank, whether in cash, gold, or investment portfolio, you can come down to Zurich and I can personally help you with the Swiss banking setup, or we can do it remotely as per your convenience. Banking diversification works best when it is coordinated with wider wealth structure. For example, many wealthy families hold their assets through holding companies, trust, or family foundations. These structures help organize ownership of assets across different jurisdictions. Within Dubai, structures such as the DIFC or ADGM foundations are often used to organize international assets under the governance framework. A foundation can hold shares in companies, investment portfolios, or other assets. Banking relationships connected to those assets may exist in different countries. So when ownership structures and banking relationships are spread across different jurisdictions, wealth becomes less dependent on one financial system. To make this more practical, imagine a family that owns businesses in the Middle East. Their operational banking may remain in the country where the business operates. Their investment portfolio may be held with an international private bank. Some of their assets may be owned through a family foundation structure in a financial center, such as the Dubai International Financial Center. In addition, part of their liquidity may be held with a private bank in Switzerland. Now, this type of structure does not completely eliminate risk. However, it means that access to liquidity is not dependent on one single banking system. International banking diversification is not about avoiding regulations. All serious banks follow strict compliance and reporting rules. The goal is to build resilience, so families connect their wealth to more than one banking system. When banking relationships exist in several countries, restrictions in one country does not affect all of their money. And because geopolitical tensions can appear suddenly, more international wealthy families are planning their banking this way. Now, if you are thinking about diversifying banking and would like help in opening international banking relationships in jurisdictions such as Switzerland, you can reach out to me directly using the links in the description below. And if you're worried about the current geopolitical situation and looking for more clarity, you should check out my next video on how to war-proof your assets right here.